Hi guys, this is another episode of Derivatives FX, and today we are talking about exchange rates, talking about a broker, and also we're talking about leverages and margin. What is exchange rate? Exchange rate is the price or rate at which one country's currency is being exchanged against another country's currency. For instance, you want to buy as a US, you are having the US dollars and you want to buy the British pounds. There's a rate at which the bank or the market will give to you. That is known as exchange rate. For instance, you want to buy the Great British pounds and they tell you it's 0.97 or 0.98. That is to tell you that for one British pounds you will need $0.97. I don't know if that is understanding to you. It will be very important for we to know that exchange rate is being determined by some factors. That is the supply and demand of that country's currency, and also the political and economic stability of that particular country. Exchange rate can be fixed or floating. When an exchange rate is fixed, that means it is determined by the country's central bank. That means it does not change from time to time. The rate is fixed. While a floating exchange rate changes from time to time and is being determined by the market. I hope that explanation is understanding to you. Let's go to the next one, which is broker. Who is a broker? What a broker does. A broker is a person or an entity that stands in between a buyer and a seller. Simple. A broker is a person or an entity that stands in between a retail trader and the market. A broker takes the order from the retail trader and presents it to the market. So he stands as an intermediary, a middleman between buyers and sellers, or sellers and buyers. Brokers are being paid either with spread or they charge commission, and spread is gotten from I'll explain that in our coming videos. While commission is just like a percentage part. They charge you in a certain percentage for the job they do for you. Going to the next one, we have leverage. Leverage is like a borrowed capital, borrowed funds. Like as the word implies, leverage is like you are relying on something to get something. I don't know if that explanation is quite understanding. For instance, you want to go into the market. You want to buy a certain amount, a certain unit of currency. You need that leverage to do that. First of all, you can't be, for instance, you are trading a $100 account, for instance, and you want to be able to trade up to $1,000. That is where leverage comes in, and leverage is being given by a broker. A broker gives you leverage to trade extra unit of currency. For instance, you have a $100 account, you can trade up to $1,000. That is where leverage comes in. I don't know if I'm giving a clear explanation. So leverage is being given by a broker. That's why broker in the life of every forex trader, a broker is very, very important, because without a broker you can't get full access to the market, you can't get leverage to trade larger unit of currency, and so on. If this is your first time coming across my videos, why don't you smash that subscribe button so that you get notified whenever I drop content like this concerning forex. Last for the day, we have margin. Margin is seen as the minimum amount you need to go into any trade in the forex market. That is the minimum amount of money you will need for you to go into any trade at all in the forex market. That is known as margin. And there are some key terms about margin I also want you guys to know. We have the used margin, which is the amount of money that you are currently in a trade with, the amount of money you are maintaining a trade or holding a trade with. We have the free margin. That is the extra money that you have that you can go into more trade or go into more position with when you're in the market. Then we have the margin call. A margin call, it occurs when, as a trader, you are close to blowing your account here. That's when the margin call. It's the broker that gives that order. They notify you that, oh, you are exceeding, you are going beyond the expected loss for that particular trade. So they signal you that, oh, you need to exit the trade, or if you are having multiple positions, you need to exit some positions just for you to be able to remain on that trade. So margin call is being given by any broker that you're actually trading with. I hope, guys, all this explanation I have given above, you will find them educating. In our coming videos, I'll be talking more about those common things being used in the forex market. So stay tuned, guys.